Melbourne has become one of the most confusing property markets in Australia right now. Prices are falling. Headlines call it weak. And yet almost every fundamental measure of the city looks strong. So what is actually happening to Melbourne right now? Today we cut through the noise. Here is the plain fact. Melbourne dwelling values have fallen meaningfully from their earlier peak, continuing a decline that has now stretched across recent months. On the surface, that sounds like a city in real trouble. But look closer and a very different picture appears. Melbourne still receives one of the largest shares of overseas migration of any Australian city. It still has the country's biggest international student population, driving constant rental demand. Its economy remains the most diversified of any capital, spread across finance, education, healthcare, and services, rather than depending on one or two industries. None of these are the signs of a city in structural decline. They are the signs of a strong city going through a cyclical rough patch. So why the disconnect between strong fundamentals and falling prices? 3 specific reasons. First, Victoria's land tax settings have genuinely deterred property investors in recent years, reducing one important source of demand more than in other states. Second, an oversupply of apartments built during the previous boom continues to weigh on that segment specifically, dragging down the averages even where houses are holding up better. Third, the same national forces hitting Sydney, higher interest rates and the federal budget's changes to investor tax treatment, have hit Melbourne too, compounding the local pressures already in play. Here is the number that matters most right now. The gap between Melbourne and Sydney has widened to a genuinely historic level. A buyer needs a household income roughly $70,000 higher to service a typical Sydney mortgage compared to an equivalent Melbourne purchase. That is one of the largest affordability gaps between the two cities in decades, and gaps this size do not tend to last forever. This is exactly the kind of setup that experienced, patient investors watch closely. A city with strong long-term fundamentals, trading at a substantial discount to its historic relationship with its biggest rival, while investor sentiment remains deeply pessimistic. Several major bank forecasters now expect Melbourne to be among the first cities to recover once interest rates begin easing, precisely because it is starting from such a depressed base. It is worth pausing on why this kind of gap tends to close eventually, rather than simply assuming it will. Cities do not exist in isolation. Businesses, workers, and capital constantly compare relative value between them, and when one major city becomes dramatically more expensive than a comparable rival with similar job opportunities and lifestyle, some of that demand naturally redirects. Families priced out of Sydney increasingly look at Melbourne as the more achievable option, offering many of the same advantages. Businesses weighing where to expand or relocate staff factor in the cost of housing for their workforce. None of this happens overnight, but it is a genuine structural pressure valve that has historically helped bring outsized city gaps back toward a more normal range over time. There is also a segment story within Melbourne worth understanding. The apartment oversupply that has weighed on the city's averages is heavily concentrated in specific inner-city precincts, with a glut of newer towers. Established houses in genuinely desirable middle-ring suburbs have held up considerably better than those headline apartment figures suggest. If you are assessing Melbourne as a buyer, treating it as one uniform market obscures a story that is really about two very different segments moving in different directions. None of this guarantees an immediate turnaround. Melbourne could remain soft for a while yet, and the apartment oversupply in particular may take years to fully clear. But the honest read on what is really happening is this. Melbourne is not a broken market. It is a strong market experiencing a cyclical trough, caused by specific, identifiable pressures rather than any collapse in its underlying appeal. Melbourne right now is a lesson in not confusing a falling price chart with a failing city. If you found this useful, hit subscribe, because we break down a different Australian property market every few days. See you in the next one.